What's up, everyone? Welcome back to the trading world. Today is September 2nd, 2025. Today was a Tuesday. And if you guys are new to my channel, I cover the market every single day, covering all kinds of real trades you can take in the NASDAQ futures market to make real money. So if you guys like this type of content, definitely consider leaving a like, subscribing, following me on X, and checking out my completely free Discord. The link to that is in my bio. So let's go ahead and jump into price action today. And that's actually the wrong screen. So today I'm going to go over everything in general, but today was so cool in the sense it was the perfect example of Pheonix model playing out all day long. It was just absolutely beautiful. Let me show you what I mean. It's going to get pretty interesting. If you guys haven't seen the video on Pheonix model, definitely go check that out. I'm going to make an update to the Pheonix model video this week because Pheonix model, I explained it incorrectly. The way I explained it is kind of a flow state version of it, but I'm going to show you the real Pheonix model in this video. So this, guys, it's crazy. The risk reward on these Pheonix models is insane. You guys might know Powell Trades. He's the guy, he's one of the guys that trades this model. He might not say he trades the Pheonix model. He might call it something else, but it's what he's trading, right? It's essentially just a rejection block with SMT, and it's so powerful. So let me show you guys essentially what we have going on here. So I've noticed the 1 minute rejection blocks are very, very powerful with the Pheonix model. And so essentially what you're looking for is a rejection block. If you guys don't know what a rejection block is, it's just a wick. It's literally just a wick. But the difference between that and like a high probability rejection block is gonna come with, first let's mark this out here. A high probability rejection block is going to come, let's also switch this to 1 minute, switch this to dark, with a liquidity sweep, because we have to conceptualize what's going on, right? The rejection block is essentially a liquidity sweep. It's going to need to take someone else's stop losses. And here you can see we have super good generated highs here. What's above these? Stop losses, right? There's a whole bunch of people that put their high stop losses above trendline highs like this, right? And if you guys just think about it, it kind of just makes common sense. Where there's trendline highs and trendline lows, those are where people are going to get stopped out. So you can mark this out like this, and you can see that we just aggressively take out all of the stop losses here. That's what's going on in this rejection block. And we actually take out a very specific high. This is a 90-minute high. And so meaning if you mark out time into quarters, so 6 o'clock being first quarter, the 6 to 7:30 being the first quarter, 7:30 to 9 being second quarter. This is a 90-minute high, the high of a 90-minute cycle. And I'm not going to go into the charts to show you, but this is also SMT, right? We have SMT with this 90-minute high. So 90-minute SMT. Once again, this is called in quarterly theory it's called sequential SMT when it's a time-based SMT. But for the sake of simplicity, I just like to call them 90-minute SMTs. Basically, any SMT with time is going to be higher probability. If that doesn't make sense, I would recommend binge watching my short form videos. I have lots of videos explaining all this stuff. But anyway, back to the Pheonix model, right? So what makes this wick, this rejection block, higher probability? What makes it higher probability? And that is, one, it has a sweep, and actually sweeps out all of these highs, not just this one, right? Specifically, it takes out like all this, but this is the high that's significant. But the rejection block, it takes liquidity, it takes what's above these highs, sell stops. It takes sell stops. I mean, not sell stops, buy stops, sorry. It takes buy stops. People get stopped out, right? And then we have SMT with it. So all you got to do for Pheonix model is literally just enter at the rejection block. Now, guys, keep in mind it has to make sense in terms of liquidity. Guys, I can't stress that enough. If the draw on liquidity is not there, this is not going to work. It's not going to be that simple. But in this case, right, you can kind of already see that we've been range bound here. And this entry is even better, right? Because you're essentially inducing this entire range. So accumulation. If you enter right at the rejection block, you'd get this entry. But if you take it as an inducement, meaning you enter above an old high, you'd get this entry. So accumulation, manipulation of that high, you're entering essentially right at that rejection block. And then guys, look at the RR on this, right? It's such a simple trade, and you can just scale out, but look at this, guys. And you wonder how Powell Trades has so much money. You watch his videos, he's living it big, and it's because he's trading a really good model, right? This is called the Pheonix model. I'm going to make an update to it later, but the way I explained it before, the reason the way I explained it before isn't valid is because I was saying you needed to wait for a line time frame change in state of delivery. You actually don't. So you actually don't need to wait for a line time frame change in state of delivery. You can actually just enter at the rejection block. You just need to have it make sense in terms of liquidity. So that was the first one. And then guess what, guys? We get it again. It happens at this low right here, right? We have 1 minute rejection block with SMT. Once again, NASDAQ being the asset that does not take the low. By the way, SMT being basically S&P makes a lower high, a higher low, or a lower low, and NASDAQ makes a higher low, meaning there is a breaking correlation between correlated assets, right? And so this right here, NASDAQ makes a lower low. NASDAQ's actually going to be stronger than the S&P, and it's going to be the better one to trade. So that's another reason why Pheonix model is so good, because you're essentially always going to be trading the asset that does not sweep liquidity, which means it's going to be more bullish, or more, if it's a bearish one, it's going to be more bearish. So the asset that you're trading is always going to be slightly more aggressive when you trade the Pheonix model. So hopefully that makes sense, right? So 1 minute rejection block. And then once again, guys, this is a 90-minute SMT, right? Why? Because 9 to 10:30, the low of that 90 minutes was right here. 10:30 to 12, the low of that 90 minutes was right here. So it's SMT within 90-minute lows. So that right there is 90-minute SMT, meaning it's higher probability SMT. 1 minute rejection block. Once again, for Pheonix model, you can just enter at the rejection block, stop below the low. And once again, guys, look at the RR on this, right? It's like my grandma could take these. Just kidding. I don't think it's that easy, right? I don't think it's that easy. But what I am saying is there's crazy opportunity in these markets. And in the video I'm going to make soon, in the short form video I'm going to make soon this week, I'm going to talk about this as well. But another thing you can do if you want to get incredibly degen about it, you can enter at the midpoint of these rejection blocks. I call this Pheonix Mini, right? Essentially half the stop loss, and now you have double the RR. So this is gonna work sometimes, not gonna work all the time, guys, but you know, just wanted to show that with you guys. I like this one a lot, and it's super sensitive, right? But yeah, look for these 90-minute SMTs, and look for these rejection blocks. So and then past that, right, essentially, right, it's just market open delivers up towards the most obvious draw on liquidity in the world, which was these low resistance highs. And in hindsight, it makes a lot of sense, right? I mean, this is just sticking out like a sore thumb. This is really obvious low resistance highs. And so if you look at the 1 minute chart, it's just like, wow, this is obvious that we're going to go here. Now, unfortunately, I was looking a little bit, I think I was looking at the higher time frame, and I was a little too focused. I should have been more observant of these low resistance highs, but in hindsight, you can see it's very obvious that why the market came up here, because these low resistance highs are super obvious. And once again, why are these low resistance? Because it's just obviously generated lower highs. The market's going to want to come back to those. So there we go. Low resistance highs taken. You can see we aggressively go up there. You could have taken this as an inverse fair value gap here, right? We have a old fair value gap. We have a wick of the first candle, a wick of the third candle. That leaves an empty area between on the second candle. That gets closed above. You could take that. Technically, according to Dodgy's rules, right? Because Dodgy's the guy who made the inverse fair value gap model. Technically, you're not supposed to take it if the wick takes out the internal high, but because of liquidity here, because we have very obvious draw on liquidity, I think this is okay. That'd be 3R. Once again, I'd probably stop either there or like here, anywhere in that range. And then you would be front running the 3-minute inversion, meaning there's a 3-minute external gap you need to make sure inverses, but it does end up inversing it. And it just kind of depends on the context. Sometimes, if you have conviction in the draw on liquidity, you can front run the higher time frame gap, but usually you want to wait for the higher time frame gap to inverse. So the 3-minute one is you want to wait for the highest time frame gap to inverse, and this one works as well. We go right up to those low resistance highs. Very, very clean trade here, right? Inversion all the way up to those low resistance highs. You can go break even here, and I don't think you can stop that at break even, but I could be wrong. I don't know. And then, yeah, essentially just one giant market maker sell model, then another giant market maker buy model. And let's look at the higher time frame real quick. We ended up coming down to these lows. We react off of them, push back up to this 1 hour gap, reject it, push back lower, then we get another buy model up even higher. So essentially the day in a nutshell. There's another. My favorite part about today was actually the first presented fair value gap, and the reason why is, check this out, guys. We have the first presented fair value gap. It's actually kind of glitched on this screen, so I'm going to show you on the other screen. I don't know why it's like that, but if I go to the 1 minute chart here, let's see. So here's the first presented fair value gap, and note this one's not the first presented fair value gap because this one is including the 929 candle in the series of 3, right? 929, 930, 931. So this one's not valid. We want to look for the first one that does not include the 929 candle, and that's right here. So drag this out on your chart. This is going to be sensitive throughout the day, and check this out. Note how it gets inversed, we back test it, and then we go lower, and then it gets inversed, we back test it, and we go higher, right? You see how the market is just interacting with it all day? If the market wants to go somewhere, it's going to basically ask the first presented fair value gap, hey, are we really going there? It's going to literally just, it's going to be talking to it like, yo, first presented fair value gap, we good, we chill, and it's going to go ask it, and then if we get 5-second change of state delivery off of it, which is the aligned time frame, we're just gonna send it, right? We're gonna send it. We're going full send towards whatever the next draw on liquidity is. And so if you guys don't know, I made a model off of this. It's called First Strike. You basically take the first presented fair value gap, and you wait for an aligned time frame change of state delivery off of it. So that would be the 5-second. And you can see in both of these, I'm actually just going to pull up the images because I don't want to have to pull it up. But in both of these, so here's the first one. This one was at 11:29 in the morning. You see the 5-second change state delivery. We deliver to max 4th standard deviation perfectly, and then we actually continue to the 8th standard deviation, and then here's the other one, right? Same thing. Oh, that's the first one. Sorry. And then same thing, right? This one you're entering. This one would be on a retest instead of a close of the change state delivery, and you actually very tiny, very subtle observation, but you're actually inducing this low here. So you're entering at the change state delivery, inducing this low. Bang, right? You see how reactionary that is, and then right to the 4th, and this actually goes to the 8th as well. Check this out. So here's the other one. Let's see if it'll load. Come on, load. Let's go. And yep, here you can see it continues up to the 8th. Note my OTE gets tapped here, my sniper model entry, right, where you measure the manipulation leg within the flow state model. If you guys don't know what flow state is, watch the video on flow state. I wish I could just have this video go for 2 hours and explain everything in detail, but you guys gotta watch all my short form videos. If you haven't watched my short form videos, some things might not make sense. That's why I made the short form videos. So go watch those. But yeah, like I said, this manipulation leg, measure out the OTE of this, which is the 0.6, the 0.7, or I think it's like 0.6 something. I don't know. There's a video explaining OTE, right? We hit it perfectly, and then hit the change state delivery up to the 4th, up to the 8th. Perfect. And, oh, this also happens within our key time, this 1310 to 1340 macro time. So, pretty cool. And, yeah, guys, very, very clean day. It's kind of, you know, sometimes it's not always easy, but what I always say is the market is always right. Like, it's not going to necessarily be easy, but the market is always right. Oh, last thing. This essentially was a really obvious 2022 model down here where we get SMT with this low. We already saw that. We break this high. It's not super obvious, but technically it does break. My computer's getting kind of laggy, so I'm going to end this right after this. But we get that breaker structure, and then we retrace to this fair value gap. And you'll note, let's actually just pull up the image because I don't want to pull this up. But this is how you can tell the market's going to start expanding, is every single gap. Let's just get this pulled up here. This is how you tell the market's going to start aggressively expanding. I think Ice-T calls it like spooling or something. But look. Actually, that's not the right image, but this is the trade, right? 2022 model where you get liquidity sweep, break of structure, retracement to a 2022 fair value gap, and then we expand. But what I was trying to show you is that when the market starts aggressively respecting fair value gaps like this, see how we respect this gap, respect this gap, respect this gap. The market, it's the market showing you its hand that the market wants to aggressively expand the opposite direction. So with that, guys, I'm going to end it here. Hopefully you guys enjoyed this video, and I will see you guys in the next one. What the heck? Come on. Make it go big. Peace out, guys.